When we started my last fund after the 2008 real estate crash, we were buying apartment buildings in the Deep South at 10 to 12 cap rates, which is really excellent cash flow for a purchase price. But by early 2019, those same apartment buildings were now trading at around a 4 cap rate with not such great cash flow for the purchase price, not even enough to make debt payments and pay investors' equity. It was really obvious with such inexpensive debt and the stock market at all-time highs that real estate was just way overpriced and due for a major correction. So I said it was time to shift gears and start a new fund that puts investors in a far safer place than all the equity real estate funds and equity real estate investment trusts out there, and started a REIT, a debt REIT, with 2 major goals. 1, investors in this new fund would own all the loans, rather than being junior and sitting behind the loans, as is the case with all equity REITs and equity real estate funds. And 2, the share price can never go down. For example, most REITs are equity investments where investors are always junior to the bank loans. For instance, if the equity REIT buys a property, say for $15 million, with a $10 million bank loan and $5 million in investor equity, and the property goes down in value to $10 million, investors would lose all their money. Our fund, PiMac Mortgage, is solely a debt REIT. So, using the same example, if PiMac Mortgage loans $10 million on a property worth $15 million, and the property goes down in value to, say, $10 million, our investors come out whole. This is really, really critical when real estate is overpriced. We're also doing very conservative loan to values and using third-party appraisals for all of our commercial property loans. We feel this is by far the safest place to put our investors in this marketplace and still have them earn very high returns.